Hello everyone, welcome to another session. Our topic for this session is interpretation of financial statements via financial ratio analysis. Well, this topic is not only relevant to students but to the public as well to analyze and evaluate the financial performance of different companies. This topic is actually in every educational qualification, be it CA, ACCA, CIMA, ICAW, BBA, MBA, and others. Let's start with the topic now. Let's go with the introduction. What are actually financial ratios? Financial statements are used to make decisions. They are used by a number of different stakeholders, including shareholders, investors, and others. We'll discuss it later on. The financial statements contain a large number of figures, but the figures themselves do not necessarily have much meaning to a user of the financial statements. However, the figures can be analyzed and interpreted by calculating financial ratios. Now let's discuss about the different users of financial statements. There are several groups of people who may use the financial statements. They include investors and potential investors, lenders, employees, suppliers, customers, government and government agencies, and the general public. Each user group has different information needs, but as a general rule, financial statements prepared in accordance with IFRS should provide all user groups with most of their needs. Each group is interested in financial performance, financial position, and cash flows, but some users are mainly interested in performance and profitability, while others may be more interested in liquidity and gearing or other matters. Now, what are the uses of ratios? Financial ratios can be used to make comparisons. Comparisons within financial statements. For example, if revenue has increased by 10%, it might also be expected that gross profit increased by a similar percentage. This is also called vertical analysis. Comparison over a number of years. By looking at the ratios of the company over a number of years, it might be possible to detect improvements or deterioration in the financial performance or financial position of the entity. Ratios can therefore be used to make comparisons over time and to identify changes or trends. This is also called horizontal analysis. Third, comparisons with similar ratios of other similar companies for the same period. And fourth, in some cases perhaps comparison with industry average ratios. Now, until and unless you do not compare financial ratios, they are of no use. Now let's move on towards the categories of financial ratios. The main financial ratios can be classified as profitability or financial performance ratios, working capital ratios, liquidity ratios, debt ratios, and investor ratios. Now we are going to discuss these ratios in further detail. Okay,